Welcome to The Explainer. Today, we're going to peel back the curtain on a trading strategy that's, believe it or not, hiding in plain sight. It's a method the big institutional players use to see the market, and by the end of this, you'll have the exact blueprint to see it too.
So let me ask you this. Have you ever been in that trade, the one where your stop loss gets clipped by the tiniest little margin, and then boom, the price just takes off in the exact direction you predicted? It is one of the most frustrating things in trading, right? It really feels like the market has a personal vendetta against your stop order.
Well, what if I told you it's not random at all? What if there were two kind of invisible lines on your chart set a full day ahead that act like magnets for price action? And no, this isn't some super complex indicator. These are simple, powerful lines that the smart money watches like a hawk.
So what are these invisible lines? Well, they're actually a lot simpler than you might be thinking, but their effect on market psychology and, where all the orders are stacked, it's absolutely massive. Let's pull back that curtain.
Here they are, the previous day's high and the previous day's low. We call them PDH and PDL for short. And let me be clear, at the start of every single trading day, these are probably the two most important levels on your entire chart. Why? Because they mark the absolute edges of yesterday's battle.
And that's exactly what they are. You have to think about the psychology here. The previous day's high, that was the point of pure euphoria for buyers, and max pain for anyone who sold. And the low? Total opposite. That was peak fear for sellers and a golden opportunity for buyers. Those emotions, they don't just vanish at midnight. They linger.
So why are these two lines so powerful? Okay, first off, they are giant pools of liquidity. Just think about it. Traders who went long yesterday, they've got their stop losses parked just below the previous day's low. And breakout traders, they have their buy orders waiting right above the previous day's high. This creates a huge concentration of orders that big institutions love to go after. Second, they're psychological fences. When the price gets back to these levels, everyone who traded yesterday is forced to make a decision. And finally, everyone is watching them, from little guys like us to the biggest banks on Wall Street. And because everyone's watching, it becomes a self-fulfilling prophecy.
All right, so knowing where the lines are is half the battle. But how do we actually turn this knowledge into a real, actionable trading plan? It's not just about drawing lines. It's about knowing exactly how to react when the price finally arrives.
The blueprint is beautifully simple. Really just 3 steps. Step 1, a few minutes into your trading day, you mark yesterday's high and low on your chart. Most software has an indicator for this, but you can do it by hand. Step 2, and this is the most important part. You do nothing. You sit on your hands and you wait for the price to come to you. We do not chase the market. And third, once price hits one of your levels, you watch for very specific reaction. And only then do you execute your plan, which you've already figured out ahead of time.
Okay, so the price has arrived at the PDH or PDL. Now what? Well, really only 2 things can happen. It's either going to slice through with real power, or it's going to get slammed back down. Our job as traders is to figure out if we're seeing a genuine breakout or a trap, a fake out designed to grab liquidity.
And this slide lays out the difference perfectly. A real breakout, it's decisive, it's strong. You'll see a big candle with a full body close way outside the level. There's no messing around, just pure momentum. A fake out, on the other hand, is a classic trap. You'll see the price poke its head through the level just for a second, but then the candle closes back inside the range, and it often leaves behind this long, nasty wick. That wick is the footprint. It tells you that institutions push the price just far enough to trigger all those stops before reversing the market hard.
So, if you see the signs of a legit breakout, here's a simple game plan. Let's use gold as an example. Let's say yesterday's high was at 2350. Today we're watching, and boom, we get a powerful 5-minute candle that closes with a full body at 2352. That's our cue. Now, some pros like to add a small buffer, maybe based on the ATR, just to avoid getting faked out. Your stop loss? It goes just below the low of that breakout candle, keeping your risk tight. And for the target, a simple 2-to-1 reward to risk is a great place to start. Or you could aim for the next big area of resistance you see on the chart.
Now, trading a rejection. Oh man, this is often an even more powerful setup. Let's take Bitcoin. Say the PDH for Bitcoin was $68,000. Price pushes up, it breaks 68K, it even hits 68,200. All the breakout traders are piling in. But then, the 5-minute candle closes all the way back down at 67,900, leaving this giant wick sticking out. That's the trap. So you enter short going against that fake move. A good place for your stop loss is about halfway up that rejection wick. And the most logical target? The other side of the map, the the previous day's low. It's a clean, mechanical trade. Now, just trading these levels by themselves is a totally solid strategy. But if you really want to get that professional edge, we got to talk about confluence. This is the art of finding spots where multiple technical reasons to take a trade all line up in the same place. It's how you stack the odds in your favor.
Confluence just means agreement. So when you have the previous day's low and it just so happens to line up perfectly with another key tool on your chart, the odds of that level holding go way, way up. It's not just a line in the sand anymore. It's a brick wall.
And what's really cool is how we can layer these different factors. First up, you've got VWAP, the volume-weighted average price. This is a huge level for institutions. When one of its deviation bands lines up with the PDH or PDL, that area becomes incredibly strong. Then you have Fibonacci levels, a rejection from the PDH that also happens to be a perfect 50% retracement of the last move. That's a high probability setup. And finally, there's the midnight open price. If you're looking for a buy, seeing the price dip below the midnight open and the PDL before reversing, that's a powerful clue about the direction for the rest of the day.
Look, we can have the greatest strategy on earth, but honestly, it is completely useless without the right mindset. A system is only as good as the person clicking the mouse, so let's talk about the single most important part of this whole thing: you.
To make this work, these rules have to be non-negotiable. First, you have to be patient. Your job is not to trade all day. Your job is to wait for that perfect setup at your level. Second, remember this: a touch is not a signal. You have to wait for the candle to close. That close tells you who won the fight. Third, you have to get your FOMO, your fear of missing out, under control. I promise you, it is always, always better to miss a good trade than to force a bad one. And finally, stick to your plan and manage your risk religiously. Once you're in a trade, your job is done. Let it play out.
Okay, let's bring it all home. We've gone through the what, the why, and the how. Now let's just boil it all down to one core idea that you can take with you to the charts.
The previous day's high and low are not just random lines. They are a living, breathing map of the market. They show you where the money is, they expose the fears and greed of other traders, and most importantly, they give you a clear window into what the big institutions are planning to do. When you learn to read these levels, you stop gambling and you start trading alongside the smart money.
And there you have it. That's a complete framework for one of the most reliable strategies out there. So now, I want to hear from you. Is this something you already use in your trading? What's your experience been with the previous day's high and low? Drop your thoughts, your experiences, any questions you have in the comments below. Thanks for watching.